The RBI's Monetary Policy Committee's April 5th to 7th meeting is happening in a context when India's growth is strong and the US economy, the Pied Piper of the world economy, is also growing strong. So, how should the Reserve Bank move on rates and on guidance? As always, CNBC-TV18 Citizens Monetary Policy Committee meets ahead of the RBI MPC to discuss the issues that will confront the RBI. I have with me the chairman of our committee, Dr. Pranab Sen, and members Samiran Chakrabarti, Soumya Kanti Ghosh, Sajid Chenoy, and Sonal Verma. Gentlemen and Sonal, thank you very much indeed for your time. Well, let me start with Sonal this time. Sonal, well, as I was just saying, the Indian growth seems to be strong. The US Federal Reserve has bumped up its growth forecast for 2024 from 1.4 to a whopping 2.1%. So how should the Reserve Bank guide on growth? Will they also push up their forecasts?
Yeah, Latha, our view is it'll be a similar story in India as well. First off, actually FY24 itself is ending on a strong note. So vis-a-vis the 7.6% advanced estimate, the current estimates that most are talking about, including the RBI, seem to be closer to 8%. So that sets us up on a strong base. For FY25, back in Feb, the RBI had projected a growth of 7%. Our sense is they will upgrade this number to potentially something around 7.2%, although in the latest bulletin, the models that they run actually have an even higher forecast of 7.4. But really, it does look like, yes, we will likely see an upward revision in India as well. And for the RBI in particular, I think they are seeing signs of private capex picking up. Global growth has been strong. Inflation in India is expected to come down, which should be positive for consumption. So on net, yes, more optimism on growth is what we expect. From our own perspective, though, our FY25 projections are closer to 6.5%. So on our side, we think the model code of conduct will mean some moderation in public capex in the first half of FY25. The private capex, we think, is not yet broad-based. And finally, I think on the consumer side, the various tightening of macroprudential norms that the RBI has announced, we think will lead to some moderation in credit growth in FY25.
Okay, Sonal, got that. Samiran, actually, let me toss the same growth question to you. Do you think growth is as strong as the Reserve Bank is making it out to be in the bulletin? And if it is, then should not the Reserve Bank sound hawkish?
So, Latha, two, three different ways to look at it. One is that there is this difference between growth as estimated through the GDP method versus the GVA method. As we know that there is, in this current point, a big divergence between the GDP and the GVA numbers. Our suspicion is that the RBI is going to talk more in terms of GDP rather than GVA, but we have to keep in mind the softness in GVA when we look at growth. The second issue is that this is also a growth which is somewhat two-paced because the investment growth is much stronger than the consumption growth. And in our analysis, we find that this could have a significant bearing on overall inflation. Historically, the output gap is not that much correlated with core inflation, but it is quite well correlated. Core inflation is quite well correlated with the consumption side of the economy. If consumption growth is what is driving the higher output gap, then there is a chance that core inflation can also pick up. But that's not the case this time around. So there is not much to be worried about the higher growth as of now. And the last point is that ultimately we have to also take a call on where India's potential growth stands. If because of all these supply side measures taken by the government, the potential growth itself has come up, then maybe the output gap is not as wide as it seems to be from the last 3 quarters GDP print. So because of these three reasons, I think RBI is likely to underplay the potential impact of higher growth onto inflation and can sound somewhat more comfortable that they've achieved both the things of high growth and low inflation on a more sustained basis.
Okay, then that should impact the stance, but I will come to that in just a bit. Let me first get all the issues on the table. Sajid, what should the Reserve Bank and the MPC take away from what the Fed has just said?
Yes, that I think, the first blush, the sense was the Fed was dovish because it had marked up its growth numbers, it had marked up its inflation forecast, it had persevered with 3 rate cuts this year, though that was a narrow majority. So the first reaction, it was dovish and kind of markets reacted accordingly. But if you dig deeper, there are various cross currents that are worrying. First is the data is really not cooperating with the Fed. Right? There was the disinflation and core towards the end of 2023 that got everyone excited. But if you look at the last 3 months in the US, for example, the quarterly annualized momentum of core inflation is above 4%. And that's not going to keep the Fed comfortable. Now, this is no surprise because as we've discussed before, much of the core disinflation last year was because of goods. Goods were in deflation, a lot of it being exported by China, right? It was services inflation that was sticky. We're now in a situation where we've passed the trough of goods deflation. Goods prices are inching back up. Services remain sticky, and therefore core inflation is, uncomfortably high. So even though the Fed wants to ease, we may get a much shallower cycle from the Fed because if core inflation settles at 3%, which is above the 2% target. The second known unknown for the Fed is just the neutral rate. What is the medium-term rate? We saw the Fed move up the medium-term rate. And there's an increasing view here that long-run rates in the US may not be 2.5%, which is what everybody thought a year ago. They may well be closer to 4% because balance sheets are much stronger. Fiscal policy is more expansive post-pandemic. And all this would argue for a higher neutral rate. And if you look at it that way, it's no surprise that despite policy rates being at 5.5%, the US economy has not gone into recession. The US economy has not collapsed. In fact, it continues to be very resilient because if in fact neutral rates are 4%, reflecting healthier fundamentals, then in fact monetary policy is not as restrictive as was presumed through all of 2023. In other words, again, there's less space for the Fed to cut. So while the Fed did seem dovish, the data is not cooperating. We may get a much more shallower cycle. And I'll end by saying that the global environment is a little less benign than a few months ago. The US is growing very strongly. Europe is still expected to grow less than 0.5% this year. So if you get continued US exceptionalism, you will get a stronger dollar, which will weigh on emerging market currencies. And finally, we've seen crude back up in the high 80s, right? So the environment now is where emerging markets have to potentially brace for a shallower easing cycle by the Fed, a stronger dollar potentially, and crude in the high 80s or low 90s.
Okay. I think I'll have, if I have time, I'll come back to the neutral rate on India as well to you, Sajid. But first, inflation. Soumya, core is really undershot, 3.3%, and the Reserve Bank had once said that that's where they will really pay attention. And chances are we are going to have a La Nina this year after an El Nino last year. So do you think the Reserve can guide lower on inflation?
Yeah, thank you, Latha. I think that on the inflation front, the story looks more comfortable, and of course, the trajectory looks benign as per the trend is concerned throughout the next till the end of next fiscal. Most possibly, the deflation in core, which has could continue a little while longer, and also the fact that if you actually look into the inflation trajectory of the RBI projections, I think the numbers could touch closer to 3% by July 2024. So, but the point to note over here is that there are, of course, statistical impact base effects are concerned. So if you take a longer period of time, inflation next year looks remarkably anchored in the range of 4 to 5%. So given this fact, and given the fact that the central bank has an inflation average of around 4.5%, which is not markedly different from the market forecast, I think that could give a lot of comfort to the central bank. But And possibly, but the most important point, I think, which Shamiran also pointed out, I think the relationship of the core inflation with the growth numbers. I think the deflation in core has actually surprised everyone. And if that continues, if the deflation in core continues, core is possibly supposed to get back into 4% after a couple of months. But even if it gets back to 4%, given the fact that we had a narrative of stickiness in core, I think that has surprised many. And possibly it will be important to understand whether the deflation in core will continue for a while, because that will give the RBI a lot of breathing space in terms of the overall reading of the inflation numbers.
Okay, well, let me toss this the inflation question to Dr. Sen as well. Dr. Sen, you're the former statistician, and we've just got this household consumption expenditure survey, which clearly indicates that the quantum of food that is there in the CPI needs to be brought down. Cereals need to be brought down, and those are the inflationary elements. So if all this is going to come into the CPI and point towards a lower CPI, how should the Reserve Bank and the MPC look at the inflation picture?
As far as inflation is concerned, there are conflicting sort of effects of the new household consumption survey. So on one hand, food as a whole comes down. So that would reduce at least the volatility in the inflation numbers. But within the food group, what you find is that cereals, which is probably the most stable of the food items, has come down very significantly, and non-cereals, which is fruits and vegetables and so on, that has gone up significantly. So you've got two conflicting. Now, because of that, and because volatility is much higher in the non-cereal component, food component, you're really not out of the woods yet in terms of the food price-driven volatility in inflation. So I wouldn't be breathing a sigh of relief saying that, this whole food business is behind us. It isn't.
Okay. Well, I was hoping that one of you will say that they may guide inflation lower, but not just yet, maybe. The more important question is going to be liquidity. And especially after the inclusion of India in the bond index, which becomes effective June. That question after the break, and of course, what will the RBI do to stance? All that's coming up after the break.